Hi everybody, welcome to the Shock Factor series video 14. And in this video, we shall be focusing on the 14th obviously the 14th hurdle in trying to apply technical analysis to the markets. And in this particular video, we shall be focusing on the ugly truth about recovery. And again, as a punchline, not all recoveries are equal. Okay. For those of you who are professional traders, you would have already experienced this in the markets over the number of years that you've been trading. But again, this is I'm trying to make it as short as possible. It's a short video, just attempting to discuss, not in great detail. I'm going to keep it as simple as possible. Of course, we can get more complex if we want to, but again, YouTube videos are not the place to do that. Okay, so again, I'm going to talk about recovery. Now, what kind of recovery are we talking about? Again, this is Shock Factor video 14. Let's proceed to the next slide. Again, in this video, it is very specific. We are only going to focus on trading accounts that are currently suffering losses and are trying to recover from the drawdowns. That's all. I'm not going to be focusing on profitable scenarios. Okay. So again, let me just reiterate. We're only going to be focusing on the recovery factor, the potential to recover from accounts that are already currently suffering losses. Okay. It's very specific. This video is very specific. Okay. Okay, let's proceed to the next slide now. Okay, the power of recovery, or the potential power to recover from losses in your account or in a trading account. Again, I'm going to deal with two very simple scenarios. Obviously, there are multiple scenarios, but I'm only going to focus on two simple scenarios or two simple situations. The first is a money management based example. The second is a market or asset class based example. Okay, that's all. Okay, so I'm going to focus on this first, and then I'm going to proceed to the other scenario, where we focus on market or asset classes based examples. Okay, all right. So again, I do not want to belabor the point too much or detain anybody any longer. Let's proceed to the next slide. So let's press on right now. In the first scenario, I'm going to focus on just a very simple example on money management based setups, whereby the power of recovery varies. It depends on the kind of money management that you're applying, okay, to your setup. Okay, let's start with the first one, a non-martingale setup. What I mean by that is that assume that you have a trading approach, and the money management that you are attempting to implement will be one whereby you'll be using a fixed percent risk based on the original capital per trade. So, for example, let me explain. For example, let's assume that you start with $100 capital in your account. This is your initial capital. And you only want to risk 1% of your initial capital. Okay, you only want to risk 1% of your initial capital of $100. That will give us, obviously, $1 per trade. This is your risk per trade. You're only risking $1 per trade. Okay? This is simple. I mean, anyone can understand this. Okay. Now, having said that, immediately we understand that your lot size will be fixed. No matter what position you enter, you'll be entering with a fixed lot size. So therefore, assuming that your stop loss is fixed and you only risk 1% per trade based on your original capital. So even if your account capital declines, say you start to lose money, you start to go into a drawdown, your percent risk or your dollar risk per trade will still remain the same, because it is based on your original capital, not your current capital. You see that? So therefore, as your account capital declines, as you start to lose money in your account with a fixed stop loss, assume your stop loss never changes. Okay, your stop size is always the same. Your dollar risk remains the same throughout the entire trading campaign. And your lot size similarly also remains fixed. So therefore, what I'm trying to say is quite simple. As you lose money, your lot size remains fixed. So for the market to lose that certain X amount of capital, it will take the same amount of work to make back, to recover, or to recoup that amount of capital because you have no edge in the market. So assume that you're trading one mini lot or one contract, depending on what market you're trading. So assume that's the case. Now, as your capital decline, as your account capital declines from $100 to $50, assume now you have only half your capital, you will still be trading with one lot. Immediately, we recognize from a drawdown point of view, once you're in a drawdown, you're still trying to recover with the same one lot. The same lot that caused you all the losses from 100 down to 50 US dollars. Now you only have half your account capital. It is still the same one lot or one contract that will try to help you recover back to your original amount and maybe beyond. So there is no edge. The same lot size which caused you the losses will be the same one, the exact same lot size that will help you to recover. No advantage whatsoever. So therefore, you have no edge with respect to recovery during losses in your account. No edge. Everything is fairly neutral. It's flat. Everything is flat. You can put it that way if you like. Now going to the martingale setup is totally different. Here, what we do is that we increase our percent risk as our capital falls. Everyone knows this. Everyone understands what a martingale is. As you lose money, you increase your percent risk. That means you increase your lot size. Here, your lot size doesn't change. Whether you're losing money, whether you're making money, it never changes. Because you have opted to use a fixed percent risk based on your original capital. Okay? Not your current capital. But for a martingale setup, it's different. Every time your account loses money, you increase the percent risk. And thereby, by increasing your percent risk, you're increasing your lot size per every losing trade or per every number of losing trades. So as you lose money, you increase your percent risk. By doing that and having your stop loss fixed, your dollar risk increases and thereby your lot size also increases. So therefore, as you lose money in your account, your lot size, assuming your stop loss is fixed, okay, just to make things all fair and equal, everything else being equal, so we don't have too many variables to deal with, your lot size increases as you lose money. And therefore, the potential to recover is significantly higher. Because as you lose money, your lot size increases. That gives you the power. If you start making money, you will recover very fast because you're now trading with a larger lot size as you're losing money. But of course, I'm not saying that this is the best way to do things. A martingale has its pros and cons as well, but I'm just focusing on the recovery factor. We can understand as you lose money and your lot size increases as you lose money in your account, your power to recover is greater. There is a higher potential of recovery. And therefore, there is a significant edge with respect to recovery during losses as compared to a fixed lot size. Okay? So martingale is much better in recovery, but it has its drawdowns as well. It has its dangers. I'm specifically focusing on the power of recovery, the potential power to recover. So therefore, there's no doubt about it. A martingale has a much higher edge, a much greater edge, a significant, phenomenal edge with respect to recovery during losses. But of course, if the losses continue, then the account will get obliterated very quickly as well. We're not going to focus on that aspect. That's a different topic. Okay, I just want to be specific. I need you to understand that. Okay. Finally, we come to the third example. Here we use a fixed percent risk based on the current capital. Different from the first. It's diametrically opposed to the first one. Okay, so this is an anti-martingale. Whenever you have a fixed percent risk based on the current capital, you are anti-martingale. Okay? All right? I'm not going to go into explain what is an anti-martingale or martingale. You can always go to Google and just type in and you get all the answers there. Okay? Because this is a short YouTube video. Of course, I can go into great detail, but I do not want to do that. So again, this is a definition, a simple definition of what an anti-martingale is. A martingale is different. As you lose money, you increase your risk. For anti-martingale, it's not the same. You use a fixed percent risk based on your current capital. That's all. Simple as that. So again, your lot size decreases for every losing trade or for every series or group of losing trades. So therefore, as you lose money, your lot size gets smaller and smaller. It diminishes, it decreases. And immediately you can understand. So as your account starts to lose money, assuming your stop loss is fixed, your dollar risk declines based on the fixed stop loss. Therefore, and thereby, your lot size will also decrease. So as your account capital loses money, your lot size gets smaller and smaller, and therefore, the potential power to recover gets less and less. You are trying now to recover with a smaller and smaller lot size, which is going to get more and more challenging, more and more difficult. So therefore, for anti-martingale, the potential power to recover diminishes. You have a diminishing age with respect to recovery during a drawdown or during account losses. Can you see that? So not all recoveries are the same. Again, this is a simplified version. It is actually much more complex than this, but I'm just trying to make things simple for a YouTube video, that's all. So no age, significant age, diminishing age. So therefore, it really depends on your money management setup. For most traders, they opt to use the anti-martingale because it is probably the safest way to go forward, to implement your trading strategy in the market, backed by an anti-martingale setup, obviously. But in terms of recovery, it is not that effective. It's not. The martingale is tremendously effective, but then you have other issues that you have to worry about, okay, that you have to be highly concerned about. Okay, so that's it for the money management-based example. Let's pop over to the next example, to the market asset class-based example. So let's talk about Forex. I'm just giving specific example, just so that it's easier to understand. Let's talk about a margin-based or leverage account where we want to trade the Euro USD, okay, for example. Now, the issue is this. For those of you that trade Forex, especially for the Euro, for any standard pair where the USD is the counter currency, they come with a fixed pip value. That means for every pip that the market moves in a market, for example, the pip value is fixed. For example, for the Euro USD, for a standard account, is $10 per pip, per every pip move. This doesn't change. It doesn't change. So as your account capital declines, the pip value still remains the same. It remains unchanged at whatever the exchange rate. Now, we don't care about margin because margin is just a temporary deposit that you put in order to engage with the market. So we're going to ignore the margin. Margin is not part of this equation. It's not relevant. Okay? But yes, of course, you have to put aside a little bit of margin in order to engage with the product because it is a leverage product, but that you get back after the trade. Okay, so we don't really worry about that. That is not actual risk. It's just to allow you to trade the instrument. That's all. Okay, so let's assume we enter a position at 1.5. Let's assume we buy one standard lot and you start to lose money. The market starts to move adversely against your long position and now it's at 1.4. Now, let's assume you enter another long position. You buy another one standard lot. Okay, another standard lot. Now, if the market moves back up, well, you start to recover. You start to make back all your losses slowly, bit by bit, as the market climbs to the upside. But you notice something. There's no advantage whatsoever. You enter with one standard lot. Over here, you enter with another one standard lot. What happens is that as you lose by $10 per pip on the way down, you gain by $10 per pip on the way up. There's not really any edge whatsoever in terms of its recovery. The amount of work that was done to lose that amount is the same amount of work that will be done to make back that amount. You see that? Now, in this case, it's different. For stock prices, it's different. As your capital declines, as you lose money, assume you bought the stock, for example, and the stock starts to move against your long position, against your investment, and you start to lose money, okay? For example, there is an opportunity for you to purchase more shares at the same dollar risk. Let me explain. For example, you entered at when the stock was at $100, for example. The stock was at $100, you bought 100 shares. for example. Now, the market moves to the downside, you start to lose money. So here you invested $10,000. $100 multiplied by 100 shares, you get 10,000. So here you're willing to risk $10,000 to get in at this stop price. Unfortunately, as in most cases, usually, the moment you do that, the market starts to move to the downside, okay, or move south. And now, assuming the market consolidates at $50, for example, now you want to get in again with the same percent risk. That means that you want to risk another 10,000. You're not going to increase your dollar risk. You just want to risk the same amount. But for that same amount, because it's $50, you can buy 200 shares. 200 multiplied by 50 is still 10,000. And therefore, you invest another 10,000. Assume now that the market starts to move to the upside, back to 100. You have an increasing edge. As the market falls, the stock price gets cheaper. You can buy more shares for the same dollar risk. You see that? So there is an increasing. As the market falls, as you start to lose money in your long positions, you have an increasing edge with respect to recovering from losses. You see that? It's totally different from this scenario. This, you have no edge. Here you have tremendous edge. Of course, we're just looking at recovery factor, the potential for recovery. We're not looking at other aspects or other elements of the investment. Okay, that's a different story. I'm just focusing purely on recovery. Can you see the difference? So going back to the earlier slide, not only it depends on the kind of money management setup that you're trying to implement in the market, that will significantly affect your potential or your power of recovery, whether you have an age, whether you have a diminishing age, whether you have significant age or increasing age. Similarly with the asset class or different markets that you trade, that too exists in terms of the market itself. Okay, the instrument that you're trading in and of itself. So this has, and as the market falls, you can buy more shares for the same dollar risk. You have an increasing edge with respect to the potential to recover from your losses. All you need is a simple move up and you start to recover very quickly. Not in this case. Not in this case. No age, neither here nor there. You see that? Can you see the difference? So again, that's all I want to say in this video. I want to keep it nice, sweet, and short. Again, I shall see you in the next video. But again, as usual, until then, take care, be safe, and bye-bye.